Hello, I'm Dave Brinkman, and I'm joined by our Chief Investment Officer, Jason Staley. Given recent volatility within the crypto markets, specifically around FTX, Jason and I wanted to get together and share our thoughts. So first, what is FTX? FTX was a $32 billion crypto exchange where buyers and sellers of cryptocurrencies would come together to transact. I say was because on November 11th, FTX filed for bankruptcy. Kind of this entire crypto trading empire kind of had vanished very quickly and really shaken investors' confidence in cryptocurrency and kind of cryptocurrency as an asset class. So Jason, with that as an introduction, I'd like to get your initial perspective on the FTX bankruptcy and collapse.
FTX was previously seen as kind of a cut above, and in some cases, kind of the financier of last resorts, the white knight. They played that role when they took over BlockFi. But I think what struck people was just how quickly this unraveled. And I think that the lack of understanding and the lack of clarity in the market really kind of led to this, precipitous fall. It became this kind of very well-known company, and now it's, in bankruptcy proceedings in the Bahamas. And I think you're seeing spillover effects. First off, it's not just confined to kind of the crypto part of the universe, the investable universe. I mean, Coinbase, which is a publicly traded cryptocurrency exchange, their 2028 debt is trading at 51 cents on the dollar, implying something like an 18-19% yield. You're seeing the effects of that, right? So it's not just that contained into the confines of the crypto asset class. You are seeing some crossover and some volatility in more traditional asset classes as well. And I think the idea of trust, ironically, what is the undoing of these digital currencies, which is the lack of trust, was the reason they were started in the first place. It was that lack of trust that really gave a tailwind to digital currencies. And then, to timestamp it, in 2022, in November, we're at this point where this lack of trust, is my digital currency safe on your exchange? Are you commingling the assets? And that's what happened with FTX. They were taking assets that were contributed, or digital currencies that were on their exchange, that they were providing, paying some form of yield, providing some kind of custody services. And those funds, or those digital currencies, were moved over to its sister company called Alameda, that was a cryptocurrency hedge fund that was trading digital currencies using massive amounts of leverage. And that is how you take a business that was purported to be worth $32 billion and have several $billion of assets, and you turn it into one of the largest bankruptcies that I can certainly remember. This is not a victory lap. Like, this is a tale of caution, because everybody can make mistakes. But there were warning signs with FTX that probably weren't there in the moment, or if they were, there were other things kind of clouding them. But at the end of the day, there were some failures here, and I think there's some learning lessons that all of us can take. We can learn from, and I think that in our process on our side of the house, and Schneider Wealth Management, is that when we contribute to private equity or private infrastructure or private real estate, we look to see, we request a bank statement. We want to be able to see where the funds are going. We verify the wiring instructions ourselves. We're certainly looking for those things, and I look back on this idea of trust, and I think that everybody can misplace trust. And I think the big learning lesson here is that a lot of investors misplace their trust in Mr. Fried, who I think is going to come under really a significant amount of scrutiny in the legal system, both in the U.S. and in the Bahamas, where he's resident. And unfortunately, there are a lot of teachers' pension plans caught up with this, and I don't think that it's a material development because they have such large scale. But I mean, every dollar counts, and I certainly think that there's a lot that we can take from as an investment community from it.
Jason, you bring up a good point around private market transactions, and the expectation from our view, and I would say from investors' view, that your level of due diligence on private market investments, like an investment of capital into FTX or any privately held business, the level of risk reward is much higher. And so your corresponding level of due diligence on a private investment should also be much higher and much more into the details and really understanding what you're buying, who you're buying it from, and how do I ultimately derive a rate of return for this investment. I think the other thing that we'd highlight to investors is with private market transactions, there typically is not a safety net like an FDIC insurance or just some form of government or insurance that would come in as a safety net for investors. Typically in private market transactions, you are not going to have that.
And I think that's the first and foremost. It's both the scary part about crypto and Web3, and it's also potentially the exciting part, which is there are what seems to be kind of limitless possibilities in this new frontier that we're talking about. But as you point out, that decentralized finance or DeFi lacks the traditional safeguards that make us feel really good. Whether it's if you custody your assets at Schwab, or you have a bank account with PNC or Bank of America, you feel good about those institutions, and you also know that there's FDIC insurance for your checking account, and there's SIPC insurance for your investment account up to certain dollar amounts. And then I think on the private side, there's you're not going through the regulatory scrutiny of the SEC when you're not a publicly traded company. Having to report quarterly earnings, getting audited financials, that transparency that's required of you when you're a publicly traded company. I think that there's a certain amount of there's a certain level of due diligence you have to do. I think for private investing, that level of diligence goes up, and it's just a matter of understanding the risks and the rewards, reading the private placement memorandums, reading limited partnership agreements. These are several hundred-page documents that have sometimes it's very mundane information, but some of it's also really important. And everybody's going to make mistakes, and I think that this is just one of those cautionary tales where everybody should learn something from this. And I think from our standpoint, it's to be even more vigilant when it comes to our due diligence. Like obviously, we have not allocated client capital to dedicated cryptocurrencies, and I think for us it was just we had a hard time understanding all of the technologies behind it, and so we elected to kind of wait and see how this new asset class developed. But from a lessons learned perspective, I think that understanding what you own, why you own it, how it fits, how it works, those questions that I think can slide to the back of your mind during a bull market where everything's going up and you're really excited and trying to generate even greater returns. I think those questions tend to get reinforced during market downturns. And I think for us, we've got really good standards of due diligence, but I think that we're going to up our game, certainly because this is a high profile failure of a company that had aspirations to change the world, and I think had many investors really excited about that possibility. And it ended up coming down to the fact that FTX and Alameda had a relationship that a lot of people couldn't quite figure out, and there was certainly some foul play on bad actors. I mean, I think when capital is plentiful and the cost of capital is zero, that capital is going to fly to things that, or at least part of that capital is going to go to things that have these asymmetric type returns, which I certainly think that cryptocurrencies and digital currencies and Web3 fall into that category. I don't think this is the death knell, but I do think it's a wake-up call. I think it's a wake-up call to the kind of the cryptocurrency asset class and the ecosystem, that there are some bad actors in there, and that there's an erosion of trust. And I think it's incumbent upon that ecosystem to prove its investment worthiness. And I think it's going to be a higher bar to establish. And it's not to say that bar is insurmountable, because nothing is. But I do think that there's corollaries out there. Like the technology exists after the .com bubble. It sure did, but it took Microsoft 13 or 14 years to get back to its all-time high. And there were certainly a very few survivors, but the ones that did come out of the .com bubble and that survived, the Googles, the Apples, the Microsofts of the world, I think that there are plenty of scenarios where you could see that, looking back and 10 years from now in 2032, that that there are going to be some survivors in this crypto ecosystem that end up thriving. But again, it's that barrier of trust that just got higher. That's kind of where we are, and I think we're still in that wait and see mode, where we want to wait and see how these evolve before we start to recommend putting them into client portfolios. I would just like to add to that I think that from the standpoint, the Mt. Gox, that happened in Japan. I think that some U.S. based investors, to the extent that they did hear about it, it probably left their mind as soon as it entered. I think that this caught national attention. This is on the Wall Street Journal, the New York Times, CNBC, and it involves some prominent investors as well. And I think that that's kind of captured the attention. And so it's certainly a topic that we wanted to address. And our hope is that that recovery for the creditors is happens much more quickly than I think that they anticipate. Unfortunately, it looks like it's going to be a drawn out process, and that what's left of the crypto ecosystem really starts the healing process with investors. And moving forward, it's going to be something to watch for sure.